Modi government completes a year in office, and who better than Dr. Arvind Subramanian, who is joining us live from North Block, the Finance Ministry, to take forward the macroeconomy story. It's looking rosier than you had taken charge, Dr. Subramanian. Thanks very much for being with us. I first want to compliment you on the macroeconomic turnaround by every parameter that you see, whether it's the twin deficits that are under control, inflation has halved, we are seeing early signs of growth. You're a candid man, and which is why I want to ask you a very candid question. Inflation has indeed halved, but who do you apportion credit to at this stage? Is it good policies, or is it a lot of fortune that came via the crude oil crash?
Well, I think it's a combination of both, right? I mean, both oil prices came down, but also I think, the government and the RBI took appropriate measures to ensure that, that inflation outcome could be sustained. For example, as you can see, the fiscal deficit has come in below 4.1, perhaps even below 4. So we've done our bit to keep that going. Also, our agricultural policies, releasing stocks on time, keeping prices in check. So I think, and then the RBI, of course, raised rates 3 times. So I think, to be fair, the gods, the government, and RBI all deserve credit.
That's a fair assessment. The gods, the government, and RBI deserve credit. But your good friend Ishwar Prasad, who we had a conversation with a while back, does believe that the government has not been able to leverage the crude crash as much as would have made him happy, at least. You're still working with crude oil levels of $50 to $80 a barrel. Are you underestimating the imponderable oil here?
You see, I think there are many, many imponderables. Obviously, things can really go, some stuff can really go wrong. But any reasonable assessment of oil would tell you that, 50 to 80 is a reasonable range. And there's a reason for that. It's not just, obviously there have been dramatic changes in the oil market, both on the demand and the supply side. But I think what is new is the sense, that realization that, the marginal pricing is determined by shale production. And shale production is very elastic. If prices go up, production ramps up to moderate price increases. Prices go down, rigs are come to a stop, and so prices go up again. So it's this accordion-like quality which is going to keep variability in prices in check, and that's why this 50 to 80 kind of range.
Fair point indeed, sir. I want to talk to you about something that has worried a lot of people who are assessing the first year of this government in office, and that is that despite all the smooth talk, despite all the smart sloganeering, despite the fact that macroeconomy has improved, it's the micros that are not picking up, and one of the reasons is that investment still hasn't broken ground. I particularly want to draw your attention to something that the finance minister said in a conversation that he did have with ET Now yesterday, that the balance sheet of banks are far too stretched for investment to pick up. They're not willing to lend. The corporates are overcapacitated. I'm going to talk to you about that in just a bit. But as far as banks are concerned, unless the balance sheet of banks begins to look better, credit offtake is perhaps not going to happen. What are you essentially focusing on to improve the health of banks? Look at the NPAs. They're still very high. 5.2% by any standard is a number that many people are not comfortable with.
I think, Supriya, I think we should look at banks and private sector balance sheets together, because in some ways, one is a mirror image of the other, right? And it's because firms become unprofitable and they start borrowing, and those debts go bad, that you see the corresponding problem on banks' balance sheets. So I would see them as one kind of composite problem. In the economic survey, we call this the balance sheet syndrome with Indian characteristics. So I think, and I would go a little bit further and say perhaps that, look, at the moment, maybe financing is not the binding constraint. Maybe the demand for credit is the binding constraint, and that's why, we have to attack private investment and corporate balance sheets as well. I think once growth gets going, then I think, the problem of resources from the bank will become a really important problem. But I think there's a third point to be made here, that, some of the improvement in bank balance sheets will have to come about by actually, addressing the problem. What do you do with bad assets, restructured assets, so on. But remember, the quality of banks' balance sheets depends upon the state of the economy. If for example, monetary conditions ease, if, for example, growth picks up, endogenously some of these balance sheets start looking better as well. So I think one has to have a kind of a dynamic view of banks' balance sheets. So point one, look at it together. Point two, therefore, is it the demand for credit or the supply of credit? And three, there is prospect for some, organic improvement in balance sheets as conditions improve.
That's a fair point, and I think you're essentially alluding to the fact that growth is essentially the answer to all the assets that the banks are witnessing, and they will have to lend for some of those assets to be converted into productive assets. But you've actually also, sir, cued me to my next question, because you said that demand is low. I mean, consumption has been the mainstay of Indian economy. A very relevant question, do you believe at this stage, is that what does all this investment really mean if there are not going to be enough takers or enough buyers of things at the far end? Is that something that bothers policymakers like yourselves, that consumption in India, which was really our mainstay, has taken a dent of sorts?
Well, remember, I think, firstly, exports have, decreased as well. So that source of demand has also been, weak. And of course, that's related to the fact that foreign markets are growing much more slowly, so our export markets are growing slowly. And also because, remember, policies in foreign markets have become aggressively, they've been easing aggressively monetarily. What that means is that our economy becomes uncompetitive because all their exchange rates become cheaper relative to ours. So the export side is weak. So that's the first point to be made. I think private investment is also weak, as you said, for the reasons we've discussed. Therefore, I think, consumption and public investment are the two, I think, parameters which I think are amenable to policy change, policy support. Because also remember, the government, the fiscal side, we are consolidating, for reasons that related to the past, related to need to maintain macro stability. We have to, we can't expand fiscal policy. So that, the two engines, as it were, that we can kind of really get up to full throttle are consumption and public investment. And of course, over time, we need to address this balance sheet syndrome as well. So these are the engines that are within our control, which we need to address in the short run.
I'm glad you mentioned public investment, because you had also let yourself expand the fiscal deficit in the budget to actually spur public investment, because the view is that public investment will crowd in private investment at some stage. What many people are beginning to question is that where are the vehicles of public sector expenditure? You had also allowed for higher capital expenditure, but we're not seeing too many vehicles of public sector expenditure just yet. And this is almost 3 months after the union budget was first laid on the floor of the House.
Yeah, Supriya, firstly, I want to, if you don't mind, people have, you also, said that, we expanded the deficit to make room for public investment. Remember, I would urge you to be a little bit careful, because we did not expand. What we did was we did not consolidate as fast as people wanted. We are still reducing the fiscal deficit. I think that needs to be borne in mind, because people think we actually are following expansionary policy when actually we are following less contractionary than what people expected. That's just a side, that I wanted to make. Everyone kind of lapses into that. But I think your basic point about where's the public investment, I think that's a good question. I think roads and railways are key to ramping up the public investment effort. I think that has to happen. The second thing, of course, is that, we've done a more detailed analysis of state budgets. I think what we find is that, state governments have also provided a lot for capital expenditures, especially, urban bodies, sewage, all those kinds of things, urban infrastructure. So I think the real challenge now is, can we get, roads and railways to invest quickly? Can we get state governments and urban bodies to invest quickly? I think that's where the public investment challenge lies now.
Dr. Subramanian, I stand corrected when you say, yes, you did not expand the deficit. You delayed meeting those numbers by a year. I stand corrected on that. But as far as fiscal consolidation is concerned, I heard you say it in the press conference early on. And for the benefit of our viewers, I want you to expound upon the point that how does the 14th Finance Commission's recommendations that have been accepted by the government, which essentially means more devolution of taxes to the state, alter the fiscal mathematics at the center?
Yeah, actually, Supriya, I'm glad you asked that question because, remember, this is something that is new and that came after we presented the budget, because now we've had a chance to examine 17 state government budgets, and my colleagues have done that. And what we find is actually a very surprising and a positive picture, because remember now, more taxes are being devolved to the states. So now 62% of tax revenues are going to be spent by the states. Earlier it was 55. So that means that you have to look at state government budgets and central government budget together. So when you adopt this all India general government perspective, you find three things, Supriya. You find that you're consolidating much more than when you look just at the central government, because, and this is, people don't recognize this enough, state governments have been more prudent on average than the central government. On average, their deficit is about 2.3, 2.4%, whereas the center has been 4%. So the amount of consolidation is more. Two, the revenue deficit also comes down by much more because actually states spend more on capital expenditure. So the quality of fiscal consolidation is also better. And as I said earlier, if you look at capital expenditure, public investment, if you look at the central government alone, you get an increase of about 50,000 crores, for example. But if you combine the states, you probably get about 1 lakh crores in extra public investment. Now, these are just budgets. We have to keep that in mind. They have to be spent quickly and spent well. But the point is that, the planning and the budgeting provides for, because of the FFC transfers, improves the quantity and the quality of fiscal consolidation, which is very important. People don't realize this. It's very important when you assess India's macroeconomic stance. It's also very important when we come to think, when we think about what inflation can we expect and therefore what are the consequences.
As one of the most influential voices when it comes to India's finances, sir, I have a very pertinent question to ask of you on rural economy. There seems to be a lot of distress there. Corporates who've been speaking to us say there is an agrarian crisis in the making. The demand has been very low in that space. And of course, there is a possibility of a lower monsoon. I know you've said that we've got enough stocks to take us through, but just as one of the key architects of India's economic policy, are you worried at this stage about rural economy? Does it concern you? Because many people believe there isn't enough spoken about the rural economy in the same breath as it is about industrialization and smart cities right now.
I think, yeah, Supriya, that's a very good question, because I think, see, when we think about agriculture going forward, I think there are two things we need to keep in mind. One is that, the agricultural sector was a beneficiary of high oil prices, international commodity prices, for about 8 to 9 years, beginning somewhere around 2002-3 up to about 2010. International commodity prices went up. Along with that, our minimum support prices went up. So agricultural incomes received a big boost. That has turned in the last 1 or 2 years, and that's kind of a structural shift. We saw 8, 9 years of very good times for farmers. Now that's changed, and that's kind of international. That's just an international development we have to deal with. Then on top of that, we have the short-term monsoon-related issues, unseasonal rains, and all of those. So in a sense, what's happening is that both have come together for agriculture, which is what is making the problem worse in agriculture. The rural incomes. It's both a secular shift and a short-term shift. So that means that we need to take this very seriously. There's no question that we have to take it seriously. I mean, not just because of what it means for inflation, but more than that, we have to do something about farm incomes. And that's why I think we need to look at all the policy options the government has available to deal with this rural incomes. And the government has and is considering a number of them.
I'm just going to take the discussion away from rural economy to Make in India, one of the biggest mainstays in the policies that this government had introduced. A little while back in your conference, you did allude to the rupee will have to be competitive if Make in India has to be a success. At one level, do you believe there is admission of sorts that the rupee has appreciated a tad too much and has made exports a little less competitive?
Yeah, I mean, see, I haven't computed the latest number after the, this recent decline from about 62 to now 63.5, 64. I'm not sure it's going to change the numbers a whole lot. But the point is, over the last 1 year, we've seen about a 10% worsening of deteriorating competitiveness in the rupee, and that's something we have to be concerned about, because as I say, it has to be seen against the context of what's happening internationally. International markets are slow, and all our major partners except the United States are following very aggressive monetary and exchange rate policies. So that's going to impact us as well. So I think when you think about Make in India, which is essentially about making our production internationally competitive, I think we need to have a competitive exchange rate. And I think that's what the Commerce Minister said a few days ago. And that's been the international experience. The East Asian experience has been about keeping that. I repeat this very often, but it's a lesson that we forget. When you ask, how did China accumulate $4 trillion of reserves? They did it in order to and by, keeping the currency competitive. So, and the East Asians have done that. So there is a lesson for all of us in terms of, if you want exporting success, there are some prerequisites, including a very competitive currency.
Fair point indeed. I want to take this forward with a question that you always put a caveat on not being asked, but I'll be failing in my duty if I don't ask you that question. But I'm not going to ask you whether Raghuram Rajan should be cutting interest rates or shouldn't he be, because that's an independent body. He's going to take that call in consultation with all of you. But yesterday, again, in an interview that I'm going to allude to, the finance minister was speaking to us and he said that he expects the RBI to cut rates. The question that I'm going to ask you as an economist right now is that do you believe the RBI has squeezed itself the window to cut rates aggressively if it has wanted to, because the latest Fed commentary seems to suggest that it will be hiking rates sooner than most people had thought it would?
Well, I don't know whether it's squeezed or not. I just think that if you look at the international scenario, the international picture, I think the Fed is one actor, but as I said, almost every other economy has either very relaxed or, in fact, China, for example, has been aggressively relaxing monetary policy. So I think barring the US, the rest of the world is pursuing fairly aggressive easing and aggressive exchange rate policies. So I don't think that, the US is one actor, it's one factor, but overall I think that international monetary conditions are eased or going to be eased even further, and I think the Fed is a little bit of an exception to this rule. And even there, they're going to cut very slow and if at all, and they're going to stretch it out because there too the signals are mixed. So I think that I don't think necessarily should be decisive in terms of what we do on our interest and exchange rate policies.
I'm not going to ask you whether on the 2nd of June are you expecting a rate cut or not, because I know I'm not going to get an answer on that. I will ask you one last question, sir, before I let you go away. There has been an issue, particularly with MAT, and foreign investors have been a little worried about it. On hindsight, and the government does have a point of view on this, and perhaps they're justified in having one, but on hindsight, do you think the government underestimated the damage on this account and perhaps failed to articulate its position well? Well,
I think it's clear that, as I said a little while ago, the reputation of the government has been affected by, the ongoing, whatever challenges surrounding tax issues. And, so that's something that I think we take very seriously. And the evidence of taking it seriously is that, the finance minister has been very, open and public, and he's taken action. We've set up this Shah committee which is going to look into, all the legacy issues, beginning with the MAT on FIIs. So I think it's through our responses and our actions, I think the government is showing that, yes, it does take these things very seriously.
Dr. Subramanian, I can't let you go without asking you almost some time back when you did assume office here and it took that flight from Washington. Has the ride been as smooth or as difficult as you had imagined it to be? Is it tough to make policies? Is it frustrating at one level given the political constraints?
I mean, people will think I'm exaggerating or being not serious, but I think, the last 6 months since I took that, has been, every day has been headier than the previous one. So it's a really exciting job. in large part because the government has been extremely receptive and open to, ideas and, thoughts and things. So I cannot say how energized and kind of enthusiastic I am. I wake up every day and said how lucky I am to have this job. And that's absolutely true.
We wish you all the good fortune to carry forward with it, sir. Thanks very much for speaking to us.
Thank you so much.
Really appreciate your time, Dr. Subramanian, for joining us right here on ET Now.